Welcome to Dorsey's Bank Counsel Roundtable, the SEC's proposed fund regulations, solutions in a search of a problem. I'd like to introduce Nick Vlietstra, a partner in Dorsey's Finance and Restructuring Group. Nick, take it away.
Thank you. Good afternoon, everyone. I'm Nick Vlietstra. Welcome to this month's meeting of Dorsey and Whitney's Bank Counsel Roundtable, and thank you for joining us. We've prepared a presentation on the SEC's proposed fund regulations. Our speakers are Tom Kelly and David Tang, both of who I will introduce in a moment. But first, a couple of housekeeping details to go over. Today's program is scheduled for 60 minutes. The materials for the presentation, as well as the attendance form, are available for download through the reminder email that went out to registrants yesterday afternoon from events@dorsey.com. Links to the attendance form and materials will also be provided to you via the chat during the presentation today. The CLE code, for those of you who need it, will also be noted in the chat once it's announced aloud by our presenters. You should send your completed attendance form to attendance@dorsey.com. Certificates of attendance will be sent to those who return the completed form. Today's PowerPoint deck will also be accessible via a link that will be included in the survey email that we will send out to you after today's roundtable. Also, please note that we will not have time for a Q&A during or after this presentation. If you have a question for our speakers, you're welcome to contact them directly or through your usual Dorsey contact. The speaker's contact information can be found in the presentation materials along with their bios. Okay, with that out of the way, let me introduce today's speakers. Tom Kelly is of counsel and former co-chair of Dorsey's Finance and Restructuring Group. He is located in the firm's Minneapolis office. David Tang is a partner in Dorsey's investment management practice, focused on investment advisor, regulatory compliance, and private fund formation. And David is based in Dorsey's New York office. Additional bio information on both of our presenters is included at the end of your materials and on our website, as is their contact information. And with that, I hand you over to David Tang. Thanks, David.
All right. Well, thanks a lot, Nick. Welcome, everyone, to the roundtable. I'm going to present the first part of the roundtable slides, and then I'm going to hand it over to Tom for the second part. So the first part of the slides here, we're going to cover proposed rules in the last year or so, 2022, and then we have one new rule in 2023, which we'll cover, that affect investment advisors and specifically private fund advisors. We have quite a bit of slides to go through, so I'm going to go through it relatively quickly. This will be at a very high level. But to the extent you have questions or want to discuss more any of these proposals, feel free to contact me. So first, before we get to the proposed rules, the big sort of elephant in the room is the new marketing rule, no longer proposed. It was adopted and now actually effective as of November 4th of last year. It took the old advertising rule and the old cash solicitation rule, amended it, and combined them into one new marketing rule. It modernizes the requirements governing advisor advertising and payments to third-party solicitors. The SEC issued a Division of Examinations risk alert in September of 2022, effectively letting investment advisors know that they will be very focused on compliance with the new marketing rule in their advisor exams coming up. Also, in the 2023 Division of Examination priorities, the marketing rule was front and center in their exam priorities. The SEC has issued only a few, in fact, I think 3 FAQs on the new marketing rule, but the most recent one regarding the gross and net performance requirements when presenting the performance results of single investments, such as case studies, has caused quite a stir for the advisor community. So some takeaways from the new marketing rule, again, very high level. The definition of advertisement has been expanded. Any communication disseminated by any means by or behalf of an investment advisor that offers or promotes the investment advisor's investment advisory services or seeks to obtain or retain one or more investment advisory clients or investors in any pooled investment vehicle advised by the investment advisor is an advertisement. The new marketing rule explicitly permits certain things like past specific recommendations, specific investment advice, provided it's presented in a fair and balanced manner. Testimonials and endorsements. Testimonials were per se prohibited under the old advertising rule, but now allowed under the new marketing rule. Third-party ratings, which are ratings, say, rankings of investment advisors, for example, by third parties are permitted, but all subject to certain conditions and requirements. Hypothetical performance, which is performance that wasn't actually achieved by the investment advisor. Related performance, which is performance of other related portfolios or portfolios related to the one that's being advertised. Extracted performance, which is performance of a subset of investments in a portfolio. Those are all, types of advertising that's permitted, but subject to very specific prescriptive requirements. Okay, so moving on from that, I just wanted to make sure we covered that because that is the big sort of topic of the day is a new marketing rule. But now moving on to the proposals. So you'll see here listed 8 proposals in 2022, and then I actually added one just from last week, a new proposal in 2023. I'm going to go through each of these. Starting with the biggest proposal, which is the Enhanced Private Fund Advisor Regulation proposal. So here, this regulation applies specifically to private fund advisors. In some cases, even applies to unregistered advisors. And I'm going to go through some of the highlights from this proposal. And this was proposed in February 9th of 2022. Now, important to note that all of these proposals, with the exception of the outsourcing proposal, which was in, I think, October of last year, and the very newest last week's custody rule or safeguarding rule proposal, all of these, except for those two, all other proposals are in what's called the final rule stage. The proposal went out, all comments have been received, and the SEC is effectively mulling it over and deciding what to do with the proposal. Okay, so the private fund advisor regulation proposal requires all private fund advisors registered with the SEC to provide investors with quarterly statements detailing information about private fund performance, fees, and expenses. Registered private fund advisors have to obtain an annual audit for every private fund and cause that auditor to notify the SEC upon certain events. Before this proposal, only certain private funds need to be audited, specifically those where the advisor has custody. Registered private investment advisors in connection with advisor-led secondary transactions have to distribute a fairness opinion and a written summary of any material conflicts or business relationships between the advisor and the opinion provider. Other requirements of the private fund advisor proposal would prohibit all private fund advisors, including those who are not registered, from engaging in certain activities and practices that are contrary to the public interest and the protection of investors. These prohibited activities would include charging certain fees and expenses to the fund or portfolio investments in the fund. For example, fees for unperformed services. They're getting at here accelerated monitoring fees in the PE space. Fees associated with the examination and investigation of the advisor. So, investment advisor regulatory expenses cannot be charged to the fund under this proposed rule. You can't seek reimbursement, indemnification, exculpation, or limitation of liability for certain activities, what are called hedge clauses, including simple negligence. Reducing the amount of the advisor's clawback by the amount of certain taxes paid by the advisor, right? So the advisor received payments from the fund, pay taxes on it, but there's a clawback on that payment. Well, you can't back out the taxes from the clawback. Charging fees or expenses related to a portfolio investment on a non-pro rata basis. So if you have a portfolio investment owned by multiple clients, you can't charge fees or expenses related to that investment on a non-pro rata basis to those funds. Borrowing or receiving an extension of credit from a private fund client, also not allowed. More on this private fund advisor proposal, certainly the biggest of all the proposals we'll talk about today in terms of importance and impact. It would prohibit all private fund advisors from providing certain types of preferential treatment. You're getting at side letters here, such as redemptions and transparency, if they have a material negative effect on other investors. It would also prohibit all other types of preferential treatment. So even those that don't have a material negative effect, unless those other types of preferential treatment are disclosed to investors. SEC is also proposing, and this is sort of outside of the private fund context, but all registered advisors under this proposal would have to document their annual compliance reviews. Interestingly, currently, that's not a requirement. This next slide covers amendments to Form PF, and there were not just one, but two proposed amendments to Form PF. This first proposal would require new current reporting of certain events for large hedge fund advisors, that's a defined term, and advisors to private equity funds. Private equity fund advisors would be required to file current reports within 1 business day of the occurrence of one or more reporting events pertaining to the execution of advisor-led secondaries, GP or LP clawbacks, removal of a GP, termination of investment period, termination of a fund. In the hedge fund context, large hedge fund advisors would be required to file reports within 1 business day of the occurrence of a extraordinary investment loss, significant margin or counterparty default event, material changes in prime broker relationships, a change in unencumbered cash, operations events, and events associated with withdrawals and redemptions. And you'll see I put a little asterisk there at the end. Basically, what they're saying is, given COVID-19 and market volatility related to sort of the meme stock episode, the SEC wants more disclosure of current, material events. The SEC does not want to be caught off guard going forward. And they're using Form PF to do so. So more on this first proposed amendment. The amendment would decrease the reporting threshold for what's a large private equity advisor from $2 billion to $1.5 billion in private equity fund assets would be the threshold. It would revise reporting requirements for large private equity advisors and large liquidity fund advisors. Section 4 of Form PF would be amended for large private equity advisors to report more information on fund strategies, the use of leverage, portfolio company financings, CPCs, CPC borrowings, fund investments in different levels of a single portfolio company's capital structure, say the debt and the equity of a single portfolio company restructurings and recapitalizations. The second Form PF reporting proposal was in August of 2022. This proposal would enhance reporting by large hedge fund advisors on qualifying hedge funds. Qualifying hedge funds are funds with at least $500 million in net asset value. This proposal would require the reporting of investment exposures, borrowing and counterparty exposure, market factor effects, currency exposure, turnover, country and industry exposure, central clearing, counterparty reporting, risk metrics, etc. There's more listed here for these large hedge fund advisors on these large hedge funds, 500 million or above hedge funds. It would also enhance reporting on basic information about advisors and the private funds they advise. So this would be all advisors, identifying information, assets under management, withdrawal and redemption rights, gross asset value, net asset value, inflows and outflows, base currencies, borrowings, types of creditors, fair value hierarchy, level 1, level 2, level 3, beneficial ownership, and fund for performance. Basically, more basic information about all private fund advisors would be required on Form PF. And that's the second of the two Form PF proposals. And rounding out the requirements of the second proposal, it would require enhanced reporting concerning hedge funds, more detailed information about investment strategies, counterparty exposures, trading and clearing mechanisms. It would also change how advisors report complex structures such as master feeder structures. Advisors would have to report each component of a master feeder structure separately, can't combine or do aggregate reporting anymore. The next proposal is the cybersecurity risk management proposal. This proposal would require advisors, registered investment companies, and BDCs to adopt and implement written policies and procedures that are reasonably designed to address cybersecurity risks. Now, many of the advisors that I work with already have written policies and procedures of cybersecurity, but this would codify that requirement. It would also require advisors to report what's called significant cybersecurity incidents to the SEC on the proposed Form ADVC. Query as to what's considered a significant cybersecurity incident. That'll be one of the sort of sticking points of the rule. It would enhance advisor and fund disclosures related to cybersecurity risks and incidents. It would amend Form ADV Part 2A to require disclosure of cybersecurity risks. Again, we've already advised many of our clients to have that disclosure in their ADV. And incidents to an advisor's cybersecurity incidents in Form ADV. So to the extent you have a material cybersecurity incident, it would be disclosed on your ADV Part 2A. It would also, and this is very common with new rules, have additional books and records requirements related to these cybersecurity requirements. The next proposal back in May of 2022 is the ESG disclosure proposal. This proposal would require additional specific disclosure requirements regarding ESG strategies in fund prospectuses, annual reports, and advisor Form ADV Part 2A. It would require both registered investment advisors and exempt reporting advisors to disclose information on Form ADV Part 1A regarding their ESG investment approach and whether they rely on any third-party ESG framework in connection with their advisory services. Form ADV Part 2 would be amended to require registered investment advisors, exempt reporting advisors are not required to complete Form ADV Part 2, to include a disclosure of the ESG factor or factors it considers for each significant investment strategy or method of analysis, disclosure of any material relationship or arrangement that the advisor has with any related person that is an ESG consultant or other ESG service provider of the advisor. And if the advisor has proxy voting policies and procedures that include ESG considerations, a description of those ESG factors, and how they're considered in connection with voting client security. So with ESG, the basic sort of principle the SEC has espoused is to say very clearly what you do when it comes to ESG, and then to do very specifically what you have said that you would do. So this, sort of in furtherance of that principle is to say, let's be more formalized and more structured in terms of what needs to be disclosed in advisors with respect to advisors' ESG practices. The next proposal is the One of the newer proposals, it's the investment advisor outsourcing proposal. This was proposed only in October of 2022. This one is in the proposed rule stage, so they're still sort of gathering comments on this proposal. This proposal would require advisors to conduct due diligence before outsourcing to and periodically monitor service providers' performance and reassess whether to retain them. So here, the idea is to say, well, do an analysis of whether you should outsource a particular task to a third party, and then do an analysis of whether one particular third party is the best third party to outsource it to. So, and then this would be done on an initial basis before you do the outsourcing, and then on a continual basis periodically after it's outsourced. It would require advisors to make and keep books and records related to due diligence and monitoring requirements. It would amend Form ADV to collect census type information about the use of service providers. By the way, these service providers, there's a list provided in the proposing rule release. It's very broad in terms of who would be covered. It includes, people like services such as outsourced trader. It would even include compliance outsource providers for the advisors. So this is pretty all-encompassing. It would also require advisors to conduct due diligence and monitoring for third-party record keepers, along with the requirement to obtain reasonable assurances that the third party will meet certain record-keeping standards. Modernization of beneficial ownership reporting proposal. This is back in February of 2022, and this really applies more to advisors who are in the equity space. It would accelerate the filing deadlines for Schedules 13D and 13G beneficial ownership reports. It would expand the application of Regulation 13D and G to certain derivative securities. It would clarify the circumstances under which two or more persons have formed a group and would be subject to group beneficial ownership reporting obligations. It would require technically Schedules 13D and G to be filed using a structured machine readable data language. So again, along the lines of what we said earlier about not being caught off guard, these accelerated timelines would give more information to the SEC on a faster basis than before. The SEC also proposed enhancement to the short sale disclosure rules under Reg SHO, SHO. The SEC proposed new Rule 13F2 and amendments to Reg SHO and the consolidated audit trail to increase market transparency regarding short selling. So market participants, not just registered investment advisors, but all market participants would be required to collect and submit certain short sale related data to the SEC on a monthly basis on proposed new form SHO. The SEC would then aggregate the data, protecting confidentiality in that sense, about large short positions, including daily short sale activity, and make it available to the public for each individual security. Again, this is a reaction to sort of the meme stock situation. Okay, so lastly, in my section of the presentation is hot off the presses, last week, February 15th, another new proposed rule. And I think, the count is now up to 9 just covered on this presentation, 9 new proposed rules inside of 12 months. Really unprecedented, new rule proposal activity. But in this proposed rule, this is really a reworking of the custody rule. Similar to the marketing rule, custody rule is a pretty old rule, and some would say difficult to work with, outdated. And so this is an attempt to kind of modernize that rule. The SEC proposed changes that would amend and redesignate current Rule 20642, which is, we know is the custody rule. And under the proposed rule, there would be a new Rule 223-1 called the Safeguarding Rule under the Advisors Act. The proposed Safeguarding Rule would, among other requirements, expand the definition of client assets to not just mean funds or securities, but it would mean funds, securities, or other positions held in clients' accounts. This specifically, and this is all over the release, would capture crypto assets. So crypto assets, to the extent an advisor is deemed to have custody of those assets, crypto's assets would be included as well, not just funds or securities. It would also expand the definition of custody to include all situations where an advisor has discretionary authority to trade for clients' accounts. So this is a significant broadening of the definition of custody to not just situations where an advisor has the authority to move assets out of a client's account, but also any situation where the advisor has the discretionary authority. Now, there is a carve out for arrangements where the advisor's discretionary authorities limited to delivery versus payment arrangements or DVP arrangements. But still, this is a big change from the current rule and a big expansion of the current rule. Advisors would also, that have custody of client assets, would also be required to enter into a written agreement and obtain certain reasonable assurances from qualified custodians. This is a brand new requirement and would be a big undertaking for advisors. So with that, those are my slides for my section of their presentation. I'm going to go ahead and hand this over to Tom for part 2.
I'm going to talk this afternoon about the proposed amendments to the regulations on open-end fund liquidity risk management programs and swing pricing, and in particular on the effect of these proposed amendments on bank loan mutual funds. Now, you may wonder, why am I doing this? Because those of you who know me know that I'm a UCC and bankruptcy guy, and I've said several hundred times over the last 39 years that I'm not a securities lawyer, which I'm not. But this is a subject that's near and dear to my heart for personal reasons. When my mother-in-law was diagnosed with Alzheimer's disease, we were very concerned about whether her assets would produce enough income for her to be in the facilities she needed to be in. And her advisor put her into these bank loan mutual funds. And it was an incredible success. She earned more than she could have earned in any other fixed income investment during those years. And basically it helped stretch her money for the rest of her life. And since I'm contemplating retirement, I kind of like having things that will do that. So this is more something I'm personally interested in than my usual areas of practice, but I am interested in it, and I've been following these rules, and I don't necessarily like where they're going. With that, we'll go on to the next slide. The existing regulatory framework was put in place in 2016, and it's centered on each fund's creation of a liquidity management program for itself. So it wasn't a terribly prescriptive set of regulations. It was more of regulation by principle than regulation by specific rule. Next slide, please. The programs that the funds were required to put together had to include asset management and periodic review of liquidity risk, classification of portfolio assets, a minimum level for highly liquid investments, and policies for managing illiquid investments, which were limited to 15% of all assets. But within these relatively broad parameters, the funds were allowed to handle liquidity risk management in a way that they felt was best for themselves. Next slide, please. The one thing that was prescribed is there was a regulatory framework for the liquidity of investments. And the liquidity rules focus on how long it will take to sell an asset and settle that sale. And so the four categories under the existing framework are highly liquid investments, moderately liquid investments, and the difference between those is whether they settle in 3 days or 7. Then there are less liquid investments, which are defined as investments that can be sold within 7 days, but will take longer than that to settle. And that's the category into which most commercial loans held in bank loan funds fall. And in fact, it was part of the regulation that was advocated for by the bank loan fund industry, because they wanted to have a home where they could, keep things that didn't trade in a regular market. And finally, there's the illiquid assets, which is whatever's left after the first 3 categories. Next slide, please. This slide I'm going to skip over pretty quickly, but it deals with the way that mutual funds, not just bank loan funds, handled the March 2020 crisis. And many of them, about 20% of them, drew on bank lines of credit to meet redemption requirements. And that's a bridge that many bank loan funds use because of the longer settlement time. They also found that 27% of mutual funds engaged in lending and borrowing within their fund family. So there's quite a bit of, if you will, credit-based solutions to any problems relating to the settlement times for the sale of assets. Next slide, please. So the proposed revisions. The SEC's proposed revisions are justified by what they define as the experience of March 2020, but they really relate to things that didn't happen in March 2020. The March 2020 crisis did not lead to any mutual funds missing redemptions. So essentially, liquidity held together. And so why would that justify large-scale changes to the regulations? That's a very good question, and one that I don't think has been well answered. Obviously, the thing about the March 2020 crisis that made it more manageable than it otherwise would have been is that the federal government and the Federal Reserve reacted so quickly that it only lasted a couple, 3 weeks. A longer crisis might create more problems than that one did. Next slide, please. So bank loan funds had outflows here, 12.4 billion, 13.4% of prior period assets during March 2020. And the prices of leveraged loans declined by roughly 13%, although they quickly rebounded. And the bank loan funds make up approximately 10% of the market for the types of loans referred here to as BSL loans that they invest in. So they're not the biggest investor in these loans, which are mostly what are described as B term loans, loans that are not investment grade, but are outstanding and that are increasingly sold to non-bank investors. The largest investors in this type of loan are CLOs, and there are others that are roughly the same size as the loan funds. Next page, please. Next slide. Actually, skip this one. So the proposed revisions are eliminating the less liquid investment category, requiring funds to classify portfolio investments daily instead of monthly, and consider market impacts by assuming the need to sell at least 10% of each portfolio investment, establish a minimum value impact standard, and maintain a minimum level of 10% of net assets in highly liquid investments. That's the one that we won't be discussing further below, but it is a change to the current rules. It would require that more assets in most mutual funds be held in highly liquid investments. But interestingly, it's one that the industry commentators did not object to. It seemed that having to maintain a minimum level of 10% of highly liquid investments didn't bother the industry participants. Now, it might bother the mutual fund shareholders who will earn less because they've got more of their money tied up in highly liquid assets, but that didn't come up in the comments. They also will require all funds to engage in swing pricing and establish a hard close requirement and impose expanded reporting and disclosure obligations on funds. Next slide, please. The elimination of the less liquid asset category is the big enchilada from the bank loan fund perspective, because essentially it would put the bank loan funds out of business. They would have to treat all commercial loans as illiquid investments subject to the 15% cap and other regulatory restrictions, and essentially would mean that they could not invest in bank loans unless and until the settlement process is reduced to less than 7 days. This is something that the SEC has been pushing for a while, and the Loan Securitization and Trading Association has also been pushing for it, perhaps because they saw this coming, but it's just not the reality of the market now. There is no standard settlement time, and the settlement times can vary widely from one buyer and seller to another buyer and seller, from one loan facility to another loan facility. And so it's the solution the SEC wants, but it's not one that is going to happen. Next slide, please. This slide has quite a bit on it about the LSTA and the other industry participants' concerns. I'm not going to go over this in detail, but suffice it to say that the industry comments pointed to a lot of holes in the SEC's rationale for making these changes. And, you know, again, if they make them, there will be a significant problem, particularly for bank loan funds, but also major problems for other types of funds. Next slide, please. There's the new definitions for liquidity classifications are here on this screen. And this this is a definition again that turns on time to settle trades, and essentially you've got highly liquid assets which will be sellable and settlable in 3 business days. You have illiquid assets, which there are several factors that go into it, including inability to settle within 7 calendar days, and whether the valuation of the investment requires the use of an unobservable input, which is an accounting concept. And moderately liquid investments is everything else, everything that's between 3 and 7 and doesn't have any of the other negative attributes of illiquid assets. So next slide, please. There are also some related changes that they're making to the way that funds value assets. There is, under the current regulations, a requirement that funds do a stress-tested analysis of the effect that their liquidations would have on the market value of their assets, but it's, again, not prescribed by the regulations. It's something that each fund is allowed to do for itself. Here, they, in the new proposals, they're very specific. Funds need to assume that they have to sell 10% of each investment, and what will be the impact of that on the market value of their overall portfolio. And the problem for bank loan funds with this is that it's very difficult to determine what you can get for 10% of each investment. There are limitations in many credit agreements on the ability to sell small pieces. So 10% sale might not even be permitted under the transaction documents. And the market is such that there aren't usually going to be very small slices traded. So valuing them will require an extrapolation from a different type of trade, and that in turn will create will create a disconnect between what will really happen and what they're supposed to be stress testing for. Next slide, please. The minimum value impact standard is another rule that essentially provides a safe harbor for looking at valuation changes under circumstances that don't trigger these thresholds. And for a publicly traded securities traded on a national securities exchange or foreign exchange, there's a value impact has to be measured only if the sales by the fund would exceed 20% of the average daily trading volume of the underlying securities as measured over the preceding 20 days. That's a pretty loose standard. It's not very likely that it's going to be triggered. But for any other investment, including bank loans, privately issued securities, and over-the-counter traded securities, you're supposed to analyze it for any sale or disposition that the fund reasonably believes would result in a decrease in sale price of more than 1%. This is a very low bar and is going to require funds that invest in things that aren't traded on national securities exchanges or foreign securities exchanges to do a lot of work to determine what they think the value impact might be of their need to sell. The SEC had a lot of general language about this, but one of the things they did point to is the width of bid-offer spreads as something that should be looked to in determining whether the 1% threshold would be met. Obviously, securities that are not widely traded, including bank loans, you may well have bid-offer spreads that are wider than 1%, and that may well be something that triggers the need to do that market value impact analysis. Next slide, please. The other big part of the amendments, which is less specifically a concern for bank loan funds and more specifically a concern for all mutual funds, is the requirement that swing pricing be adopted and related requirement for a hard close. Swing pricing is essentially when someone wants to redeem their shares, and if the redemptions are a net positive amount on any day, the fund needs to adjust the net asset value to allocate the costs of redemption to the redeeming holders rather than having them borne by the remaining holders. And what they need to look at is the transaction costs of selling and the market value impact. This same requirement would apply to large net purchases of greater than 2% of net asset value, but it's really aimed at the net redemption situation, the liquidity crisis situation. The SEC's concern is that the big boys will be getting their redemptions in quickly and will get better pricing than individual investors. And this is the way that they want to offset that risk. Under the existing regulations, swing pricing is optional, and no US mutual fund has adopted swing pricing. And the reasons for that are that it would require operational and management changes in the way the funds invest that would be very expensive to implement and would eliminate some strategies that funds use. And there are other ways to manage the liquidity risk. Next slide, please. The accompanying hard close requirement is simply a requirement that orders to buy and sell shares must be received by the fund before the time that they calculate net asset value at the end of the day. And for almost all funds, that's 4 p.m. Eastern time. Anybody whose orders are not received by the fund prior to that time would get the price on the next day. They would not get the same day pricing that sellers like to get. And this is particularly a problem. I'm going to jump 2 slides ahead now, and then I'm going to have to go back. This is particularly a problem for individual investors and retirement savers because they tend to purchase mutual fund shares through intermediaries. That's how I do it. And as a result, they would have to get their orders in much earlier in the day, depending on when the intermediary would need to have it in order to promise to deliver it to the fund by 4 o'clock. And as a result of this, several of the commentators from the industry said that these changes would guarantee that individual investors would almost certainly, and retirement funds would certainly get the next day price. And, that's disadvantaging the people that the SEC wants to protect with this regulation. Dave, can we go back one now? A big part of the SEC's argument for why swing pricing should be adopted and a hard close is that's the way they do it in Europe. And the commentators have pointed out that there are significant differences between the European market and the American market, and that really make the European experience inapplicable to the American market. I don't know enough about these things to be able to judge, but it seemed to me that the commentators had a pretty good argument for why we do things differently over here. The SEC also acknowledged that there were other ways of addressing the issue of allocating the costs of redemptions to the redeeming shareholders. And some American funds have done those kinds of things, you know, essentially charging a fee for redemptions and the like. But the SEC wants a one-size-fits-all solution, and that's what they proposed. Let's go ahead 2 slides now. There are reporting and monitoring changes. I'm not going to spend a lot of time on this. The first one has to do with Form N-Port, and this is the most important change. Currently, these reports are given quarterly and 60 days after quarter end. And the only information that's made public is the information from the last month of the quarter. Under the new proposals, they would be made monthly, 30 days after month end, and 30 days after that, the information would be made public. So a much greater reporting obligation together with a lot more information being made public. They would also require allocations, you know, that the fund report on the allocations to the 3 liquidity categories of its investments, and it would include a new report on swing pricing. None of that being an obligation that the funds are interested in taking on. Next slide, please. There's also another form called N-CEN that they're amending. They're focused here primarily on information concerning liquidity service providers, consistent with their concern with liquidity throughout. So they would require the information that's shown on this page with respect to each liquidity service provider, and essentially there have to be a lot more disclosure than there is today on who is providing advice to the fund with respect to liquidity. I think that's the last slide. Actually, no, there's one more slide, and that deals with Form N1A. And essentially, these changes are simply conforming what's reported to what's being required in the changes to the liquidity monitoring rules. So this is a pretty straightforward change and shouldn't be a huge burden, except to the extent, of course, that the whole thing is a huge burden. So that's what's proposed for the liquidity risk management rules for open-end mutual funds. You know, it's a very prescriptive proposal. It's a totally different philosophy than what the current requirements are. It really is a we know better than you do kind of proposal. It would also have the effect, or at least the industry commentators say that it will have the effect of restricting access to mutual fund investors to certain products. That's where the bank loan fund issue comes in. That product would have to be changed to something else. The SEC did propose that there are alternatives in terms of converting to close-end funds or interim funds, but they wouldn't have the daily liquidity feature, which makes open-end funds attractive. And you know, there may be other solutions out there that you know, haven't been discussed by either the SEC or the commentators, such as, you know, investing in CLOs, collateralized loan obligations, instead of directly in loans. I don't know whether that would be a practical solution or not. But what it does mean is that these proposals will have a negative impact on individuals who invest in mutual funds, particularly bank loan funds, but not only. And that's a very large number of voters. So it's going to be very interesting to see how the politics of this plays out. The SEC provided a very short comment period on this, as they have on many of their regulatory proposals. And it'll be interesting to know, it'll be interesting to see whether that political impact of what they're doing is something that gets brought to their attention. These new regulations are very typical of the Biden administration's approach to financial regulation. It's very prescriptive. It looks for unfairness, whether or not it's clearly there, and it's pretty hostile to the industry. So not a huge surprise. There are a lot of good arguments that the industry commentators have made about why this should not be adopted. And particular provisions in the rules have been really strongly objected to, and with very good arguments. The Investment Company Institute, which probably is the most interested organization, basically wants the whole thing tossed. I doubt that will happen, but I hope that they'll make some revisions so that this new proposal doesn't have the effect of wiping out bank loan funds and otherwise limiting the investments that are available to mutual fund investors. Thank you. I think I wrapped up a few minutes early here.
Well, thank you, Tom.
Yeah,
sorry,
this is David, and I'll just chime in just to say, if anyone has questions on my section, any of the proposed rules, the marketing rule, and some of the sort of difficult issues that come up from there, feel free to contact me.
And the same on the liquidity rules and the effect on bank loan funds.
Okay, well, thanks, Tom, and thanks, David, and thanks to our audience for your attention and attendance. Please do remember to sign the attendance sheet and return it to attendance@dorsey.com. And again, if you have questions for our speakers, you'll find their contact information in the presentation materials. And of course, you can reach out to your usual Dorsey contact as well. Planning for the next meeting of the Roundtable is already underway. So look out for your invitation to the next Bank Counsel Roundtable. And we look forward to hosting you again soon. Have a good evening, everybody.
Thanks very much.